Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Earnings seem to be coming in pretty solid. Is it enough to support this market? Lori Calvasina joins us. She's head of U.S. equity strategy at RBC Capital Markets. She's usually on the road. When she's back in New York, we grab her and see if she can come into the studio, and we appreciate that. Lori, what are the conversations you're having with your clients these days as you do travel around to see them?
Everyone's nervous. Everyone's jittery.
Nervous.
I wouldn't say that people are super bearish, and maybe one good example is I was in London a few weeks back, and I'd been there in December, and in December, everyone was bearish. This time it was more wary, cautious, concerned. I got back to the States and started running around a whole bunch of different cities, same kind of vibe.
So jittery, of course, there's a lot of uncertainty. So I want to dig into what's driving this jitteriness from them. I mean, of course, we have the S&P 500 up about 15% year to date. Looking at the VIX index hanging around the 16 handle right now, where are people feeling? Why are they feeling this?
So I think valuations are, at the end of the day, the one thing I hear in just about every meeting. And what we see in our own data is that we're not at tech bubble extreme. So I know there's lots of talk of a bubble, but we are, whether you're looking at S&P top 10 names, S&P market cap weighted, NASDAQ 100, kind of the workhorses of the market from the earnings perspective. They're bumping up against the ceilings of kind of the pre and post COVID era, and they're not breaking through. We haven't seen any expansion on the PE multiples if you look broadly across the indexes since August. So I think people are feeling that. Some clients who have been really bullish on CapEx back in the summer are saying it's just not quite as strong as we thought it would be. I've had a number of conversations on rate cuts, and we were really hearing a lot about that in June and July. And now I've had some people say to me, well, yeah, rate cuts are bullish, but we already pulled all that forward. So I think it's a sense of valuation whiplash. And then, of course, the AI related stocks are doing well now, but they have had some difficult days. And there's been a lot of jitteriness on those, not from people who are bearish on the theme, people who have bought into the theme, but have seen how far it's run and now concerned it's hitting some speed bumps.
Fair.
Do you think earnings are going to be strong enough this quarter and then the guidance into the last couple of months of the year, then into next year? Are earnings going to be enough for this market?
So I think earnings are a solid foundation, but I think the sentiment around earnings has also gotten overdone. And what I mean by that is if you look at the rate of upward revisions, it hit 28% for the S&P 500 in late April. That's typical of a trough and a decline outside of a big crisis. Fast forward to mid-August, we had rallied into the mid-60s on that stat, and that's about as good as it gets if you're not recovering off a big crisis. And now that stat has been decelerating, and it was, I think, about 52% in our update we took late last week. So you're not quite in negative revision territory. We're seeing basically every sector decelerate except tech, which is kind of stalled around all-time highs. So the big question is tech going to join the rest of the crowd and start to decelerate, or is it just going to stick around at all-time highs? The only sort of industry or sector I can really remember staying at all-time highs for an extended period of time was home building pre-GFC.
Yeah. I used to cover home builders for equities team, and it's interesting to watch, the rally that we saw there. But I want to dig back into tech, as we've been spelling out here. We're going to hear from a lot of the big names this week. The conversation has really been are we in a tech bubble? What do you make of that?
So, I started in 2000. I literally got my job in March of 2000 when they were giving out finance jobs to poli-sci majors. But, I saw the implosion. I didn't see the buildup. But what I see in my data today, again, the valuations are not back to where they were at that point in time. Yes, they're extended. They're also extended for the rest of the market. So I think it's a broader valuation problem. We have some charts where we look at net income share of the top 10 market cap names against the market cap share. And there is a gap, but there has been a gap where kind of the market cap share has exceeded the net income share, for the better part of the past decade. I think there's more earnings support to this trade than there was in the past. Is it maybe a little too exuberant? Probably. But is it a bubble? I don't think so.
So What sectors or factors are screening well for you now? I'm guessing it's kind of few and far between given how the lift we had.
I mean, anything AI related looks expensive. Okay. So that's going to be industrials, utilities, and also the tech sector had been looking more neutral on our models, but now it's looking elevated again. Consumer discretionary also looks expensive. That's our one underweight sector. We're neutral, those others I mentioned. We're still overweight financials, definitely more nervous in the wake of sort of the private credit issues, but our banks analysts have thought that pain was overdone. So we're sticking with that overweight. Materials we've liked. And then we haven't upgraded the healthcare sector, but we have written in some of our weeklies that on a tactical basis, if you're worried about a pullback in the market, which we are, it looks like the best defensive option. We've generally been market weight the defensive sectors, but we've got nice flows, nice valuations, good earnings revision trends that are decelerating, but are not as decelerating as much as, say, industrials and materials. You've got policy risk, but maybe the worst of that's behind us.
So moving over into the macro, what did you take away from the latest CPI report, especially given the fact that we have this Fed meeting coming up on Wednesday where we'll get the decision?
So, what our economists have said was they were not so worried about, kind of this inflation report, right? That, they thought this was going to be a pretty reliable report. They also said that you got a lot of help from owner's equivalent rent, and they don't expect that to continue. That sort of the pressures on goods on goods pricing is persisting. They're seeing some pressure on services. So they're still worried about inflation in core terms hitting about 3.5% in the middle of next year. Our rates team has said we get the cut this week, but they think there's a pause in December. They think we get 2 more cuts next year. But I would say as a house view, I think RBC has been a little bit more concerned about inflation and its reverberations on the Fed than maybe some other shops.
Lori, as you know as well as anybody, a good solid bull market needs some healthy pullbacks from time to time for some sustainable period of time. We haven't really had that in this market.
We haven't. I think the worst we got, we've had some big rumblings in some of the tech names. We've had the momentum trade breakdown, briefly in both the Russell and the S&P. It has been enough damage. We've also seen the gyrations in gold. Retail passive flows are starting to deteriorate. I see a lot of signs of fatigues and that things are not necessarily completely healthy under the surface. We've been looking for a 5 to 10% drawdown. If it gets postponed, we don't think that it's derailed that pullback. It's possible it's going to get delayed. But I think at these valuation levels, it's inevitable.
So some people have been talking a lot about market froth here. How much further do you see equities rallying? I mean, it has been a really relentless year, especially if you think about 2 years previously. We were seeing more than 20% returns on the S&P 500. And going into this year, there was a conversation about whether or not we might not even reach close to that. But here we are sitting at 15% gain on the year.
I think we're going to have to, keep a very close eye on the technicals in here. My year-end target is actually below where we are now. We do have a second half of 2026 target up around 7,100. And some of our modeling, frankly, can get you to 74, 7,500. That's our sentiment and cross-asset work, which were the most bullish models for this year. I think that you can only really get there if you have the pause that refreshes, but we'll see how it goes.
Lori, thank you so much for joining us. We always appreciate getting a few minutes of your time. You know how busy you are. Lori Calvasina, she's head of U.S. equity strategy at RBC Capital Markets. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
With the president in Asia, it kind of feels like that's where the focus is of everyone in Washington. And maybe that's a good thing because Washington's still closed. They're not
pretty
working.
Quiet.
They're not open for business. And we were down there a couple weeks ago for a remote broadcast, and boy, you can go to any monument outside, the Lincoln Memorial, my favorite. Not a lot of people there. Not a lot of tourists. I mean, it's just, and the buses are not going around. Parking spots available on the street.
A little different.
A little bit different there. Henrietta Treyz joins us here, co-founder and managing partner of Veda Partners. Henrietta, as we go into week, 4 here coming up for this closure, what's the feeling in D.C. these days? Is this good for anybody? Is there lasting damage for anybody? Or is just nobody really paying attention here?
It's really kind of a surreal, suspended animation kind of place right now. The House Republican Conference is not even in session, so they're not in D.C. So the temperature on the Republican side, from my perspective, is a lot more calm. They just are, the president doesn't care about this, our voters don't care about this, so therefore we don't care about this. And then on the Democratic side, there's a little bit more action. Hakeem Jeffries is calling the entire Democratic conference back to D.C. this week. So they will be there. There will be press briefings. They'll be talking about the ACA subsidies. And they'll be trying to generate some sort of momentum in one direction or another. But as you just pointed out, as long as the president is not engaged, there's not going to be any forward progress. So the government will be shut down for at least another probably 10 days at a minimum.
So are there any sort of long-term consequences that you should expect coming out of a government shutdown? Of course, this is the second longest, the longest government shutdown being about 35 days.
Right. Not even is there a long-term impact in terms of just what the government can do. They'll all get back up and running again. The same employees will still be there. All these firings that Russ Vought has done will be overruled by the legal courts, as has been the case since Doge started, and we'll get back to business. And there's not even really an impact from the voters' perspective. When they have shut down in the past, Republicans haven't paid a price for it in elections the next cycle. It's a full year away from the 2026 midterms. So voters are going to forget about this, move on, we'll reopen. The one thing we don't want is a rolling stream of shutdowns. So hopefully they'll reach a deal to reopen, and then they'll keep it open for at least a year or 6 or 7 months.
All right. We'll leave that where it is. I live in the state of New Jersey. We have a governor's election there. I did my early voting this weekend. There's one also in Virginia. How's the Democratic Party, how's the Republican Party looking at those two states?
I think it's interesting to have a conversation about those elections in the context of the shutdown, because one party or the other could generate some momentum based off of what happens on the Tuesday election. So if Democrats pick up both races in Virginia and New Jersey, which is what the polling is currently suggesting, I think Dems are ahead by 5 in Jersey and by 12 in Virginia, then you'll see at least a media narrative or, a talking point for the Democratic Party. The voters are turning away from Trump. They're turning towards the Democratic Party. And if it goes the other direction, the reverse. And it would probably be even more extreme for the Republicans, since that's not consensus and expectations from the polls. So I think it could generate some momentum right when Trump is returning to D.C., right as we're heading into what should be a Veterans Day recess starting on Friday, November 7th. And that could move some things around on the shutdown front.
Where are your eyes most fixed right now? Are any of these races expected to be close?
Not really. I think that, we constantly see New Jersey as the great white whale for the Republican Party. So there's a possibility of some sort of movement there. People will be looking at margins, but pretty much we're expecting a Democratic win in Jersey, in Virginia. It should be a sort of blockbuster year for Democrats as the minority party going into 2026. So there's Supreme Court cases and judges' elections in Pennsylvania, Prop 50 in California. There's a lot of things to watch, but it should all generally go in the Democrats' direction, as it would in, the reverse if Democrats controlled everything right now. So not expecting anything major to come out except for that potential momentum play and media narrative to come out of this.
Henrietta, I can give you some local color here. Being in the greater New York, New Jersey metro market, we were just getting crushed with TV political ads. It's just brutal. What Mr. Citarelli, the Republican candidate for governor, is not doing, he is not running on the coattails of President Trump. He's not invoking Trump and Trumpism and MAGA at all. Does that surprise you, or what does that tell you?
Well, voters tend to vote in sort of a swing. They go in one direction one year, and then they decide they don't like what they just did, and they go backwards, especially when one administration is being really proactive or really active, passing a lot of legislation, very much in the news all the time. Voters tend to not like that. So it makes a lot of sense for Republicans, especially in a state like New Jersey, to run away from MAGA, to run away from Trump, because Trump's approval rating, especially on his core issue of the economy and inflation, is seriously underwater. I believe the worst he's had in both of his terms is his standing with voters on the economy and inflation. And that's, of course, due to the tariffs. Voters don't like the one big, beautiful bill. So I'd be running away from it, too.
All right, we'll see. Henrietta Treyz, co-founder, managing partner at Veda Partners. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We continue to face a dearth of economic data with the government shutdown here. We did get some CPI data last week, a little bit higher than I think the Fed wants to see it, stubbornly a little bit higher than where they want to see it. So what does that mean for our Federal Reserve? Let's check in with David Rosenberg. He's founder and president of Rosenberg Research and Associates. And David, we actually did get a piece of government inflation data last week. I'd love to get your thoughts on it here and how you think the inflation outlook may influence how our Federal Reserve looks at the interest rate scenario.
Well, as far as the CPI report is concerned that came out on Friday, it's really not a case of inflation still being above the Fed's target. The Fed can't be focused on a lagging indicator. It has to be focused on where inflation is going to be a year from now and 2 years from now, because its policy moves influence the economy and prices with a lag. So when I hear, well, inflation is still well above the Fed's target, my eyes just roll. It's really a meaningless comment. It's where inflation is going. That's how the Fed rolls,
though, right?
Well, if the Fed rolls that way, then they wouldn't be nudging the market towards a view that they're going to be cutting this week and probably cutting one more time between now and the end of the year. So I think that the bottom line is that when you look at Friday's numbers standalone, the headline and the core came in fractionally below expected. And we're finally starting to get some help out of the dominant rent and OER metrics, which have lagged well behind the actual deflation that we've seen in residential rents in real time. But there are inherent lags that are built in. And the other part of this is that, when you're taking a look at the core goods CPI, it's no longer deflating, it's inflating modestly. But the tariff impact so far in the goods sector has actually been fairly mild. If I was at the Fed, I'd be encouraged by that.
So how exactly are you expecting them to interpret this? I mean, of course, all eyes are on this upcoming meeting in the midst of the fact that we do have a major absence of data here.
Well, as it comes to, the inflation side, what the Fed should really be consumed with is where inflation expectations are. And when you look at the broad array of inflation expectation metrics, they're running at the, oh my Lord, 2.3%. When you look at 5-year and 10-year TIPS break-evens, they're not that far ahead of where the Fed's de facto target is. And yet the Fed funds rate is at least 100 basis points above neutral. So that's where I line up. And of course, the Fed's got a dual mandate, not a single mandate. And the labor market is showing signs of cracking. There's no doubt that the firing rate is low. Heading into the government shutdown, looking at initial jobless claims, they weren't really doing anything more than just stabilizing. So companies are still hoarding labor. But the problem is that the hiring rate has, fallen dramatically. And to a point now where employment is contracting. We don't have the non-farm payroll numbers, but we have the ADP private sector employment numbers, and they've declined in 2 of the past 3 months. So we're building up slack in the labor market. Cracks are emerging. They can't ignore that. At the same time, you could argue that inflation has been stubborn. But, there was a time when inflation was 9%, back in 2022. And people were saying we'll never see 3% again, let alone getting to 2%. Well, we're at 3%. So I would still say the trend is down when I hear about sticky. The overall trend is still towards disinflation. I think we've got to be amazed that we're still roughly around 3%, even with the tariff impact. And if we get some more news out of residential rents, which I think are going to be disinflating further. And remember, that's the dominant force. The tariff impact on the goods side is really a small share of the CPI. We continue to see the rental disinflation in the CPI data. People will be surprised by this time next year how low it's going to be.
So follow up on that, David, because this is a market that we've been told for years and years and years, the housing market. We have a housing shortage, and rents been reflected in rents, and the high cost of housing and the housing affordability is just out of reach for so many consumers out there. Talk to us about the real estate market and how you think that may impact the economy.
Well, housing affordability has begun to improve, actually, because of two factors. One, of course, is the bond-induced mortgage market relief that we've seen. But we're also coming off 5 consecutive months of home price deflation. And the gold standard for home prices, quality adjusted, is the Case-Shiller Home Price Index. It's down 5 months in a row. That's not a blip on the screen.
Okay.
That is a pattern. So, when I hear about that there's a supply shortage of housing, how do you explain that in the context of 5 straight months of negative readings on the Case-Shiller Home Price Index? The problem is that demand has fallen below what you can argue was a tight supply. You can only get negative pricing in anything if demand is faltering relative to the supply curve, no matter what that supply curve looks like. And so the other part of this equation, of course, that nobody looks at, because we talk about the stock market all the time being underpinned by, 10% growth in corporate profits, is that personal incomes are actually deflating. We have this unusual circumstance because of the equity wealth effect on spending, that consumer spending in real terms since April is up 2.6% at an annual rate, against the backdrop of negative 1.2% in real disposable income. So the problem, even though affordability has begun to improve at the margin, remember that the denominator is income. And because the stock market, the labor market is showing cracks, personal incomes are starting to actually contract in real terms. And if I'm sitting at the Fed, that's an alarm bell. Because personal incomes represent 70% of total labor income and drive 70% of the economy ultimately, which is the consumer. The question is, how long can the Energizer Bunny last because of the equity wealth effect and declining savings rates when personal income in real terms is contracting? When I mentioned that negative 1.2% trend in real personal disposable income since April, nobody believes me until I show them the data. And, you're talking before about, are we heading into a recession? Well, I got news for you. When it comes to real personal incomes, not profits, mind you, but real personal disposable income already is in a recession.
Well, David, you did mention markets here. And of course, we know markets closed at a record high last week when we look at the equity market, even with all the disruptions of the year, whether it be geopolitical tensions, tariffs, inflation concerns, we're still seeing markets rallying here. How far do you expect this rally to continue? Is the optimism already baked in?
Well, I've been saying that for a while, but as Bob Farrell, my hero and mentor, famously posited, exponentially rising markets can go further than you think, but they don't correct by going sideways. And we are in the further than you think zone of the stock market. So I think we're in extra innings, but only a brazen fool would say to you that this is going to end tomorrow, next week, or next month. The momentum and the sentiment is just overwhelmingly strong. I was saying these same things back in 1999. The market didn't peak until March 2000. So could it go even further than we think? Absolutely. We're in a 2 standard deviation event when it comes to the multiples in the stock market. And we've been there for several months now. But, bubbles can typically last. I mean, on average, when you talk about what is a bubble is anything north of 2 standard deviations above the historical norm. And we've been there for some time, but you can actually be there for, 18 to 24 months. So the clock is ticking, but I'm not going to tell you that it can't go on further over the near term. It probably will.
David, thanks so much for joining us. Always appreciate getting a few minutes of your time. David Rosenberg, he's the founder and president of Rosenberg Research and Associates. Coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's check in with Lisa Mateo and see what she's got with her newspaper segment.
All right, I thought of this one with you, Paul. Okay, I know you're a Landman fan, okay?
Yep.
So
and Yellowstone.
Okay. Exactly.
Yep.
So it's the guy behind it, right?
Yep.
Taylor Sheridan. So the Wall Street Journal, sources are telling them, also Tulsa King too, that's another one. He signed a deal to join NBCUniversal when his contract with Paramount expires in 2029. And this is a huge deal because he's one of the biggest providers of shows at Paramount Plus. So the difference at NBCUniversal, they're saying he's going to create films for the movie studio Universal Pictures in addition to the TV content for NBC and the Peacock streaming. But the timing of it, I mean, think about it. It comes less than 3 months after David Ellison's Skydance acquired control. Right. And Ellison was saying that, he wanted to keep Sheridan on board. So this is like some interesting news behind all the talk.
He's really tapped into a vein of kind of programming that some people like to really see and play it up. And he's pretty darn good at it. But you know what? It's interesting. He said he was an actor and he was tired. I think his term was, I was tired being on the 5th page of the call list for actors. And so I just said, I'm going to start writing my own stuff and producing my own stuff. And now he's created this empire.
Here we are. I've never seen Yellowstone.
Crazy. I haven't seen either of them. I hope Tulsa King was pretty good too.
Tulsa King is another one that he does. So he's on a crazy hot streak. It's a great win for NBCUniversal, and it's a big loss for Paramount because Paramount Plus has really relied heavily on his programming to kind of launch that Paramount Plus. So that's a big loss.
It is definitely. Okay, so Halloween season, right? We got fall fever in the air. We're talking pumpkin lattes, right? Apple picking. Love it, love it. But some people are going all in. They're paying stylists hundreds, sometimes thousands of dollars to decorate their porches, okay?
Oh, wow.
I just put a wreath on my door and I call it a day, like with a scarecrow, and that's it. But these people, and what the Wall Street Journal is saying, which is interesting, is that they're like Insta porches, right? Because it's all about the Instagram and what you post. And if you're having family over, you have to impress. So it's sparking this like micro economy, this senior little micro economy for the season, where people are paying a lot of money. So they have like jack-o'-lanterns, corn stalks, mums, Halloween decorations, all this on their porches. Some of them, there's one company, it's actually called Porch Pumpkins in Texas. They say they're going to decorate about 1,300 households throughout the area, and people pay like big money for this. It's crazy.
Oh my gosh.
I don't know.
I live down in a Jersey Shore town where in the wintertime there's like nobody there.
Yeah.
But they still decorate their house to the nines. and it's completely dark. There's nobody there. So I'm like,
compete with one another.
Well, it's like a competition sometimes. Like who has the better porch?
And it's not like they went out to the local store and got a couple of pumpkins. No. They hired somebody. They went professional. They had people.
It doesn't even feel like Halloween. This time is flying. My goodness.
Well, there's some people are really nuts about Halloween.
Sure.
It's big, but
the big skeletons.
For a lot of people, it's like as big or bigger than Christmas.
I was going to say a major U.S. holiday.
Yes. Yep.
Well, that's what they're saying. This is becoming like the Christmas. And they say they get more bang for their buck because they get Halloween and Thanksgiving in one.
All right.
We'll see. Okay, so this last one, it's about Apple's iPad Pro. I don't have one, but users are saying that it heats up, and that's the problem with it. So Apple says they have a fix. This is from Mark Gurman. He says they're working on a vapor chamber to improve cooling performance on the gadget as early as 2027. Now, I don't know if either of you had the iPhone 17 Pro Max
I'm still on the 14.
No, not
16,
yet. Okay.
I'm good.
Well, this technology is actually in that new iPhone. So they're going to bring it to the iPad. But what they're saying is that, it's a good chance to like get people to upsell. Like that's why they put it in the iPhone 17. So now more people will spend because they're like, I don't want my hand heating up. Because that was the issue with it. The titanium case, your hand would heat up if you were on it for too long.
Right.
I don't know. Just sitting out on the beach, like I'm apt to do in the summertime, I can go 10 minutes and then my phone just goes dark because it's too hot.
Oh, it heats up. Yes.
We got to fix that. Somebody's got to fix that.
See? Well, maybe you have to go for the iPhone 17, Paul.
I know.
Finding ways to make us upgrade always.
Exactly. All right. John Tucker still got the flip phone. So, Lisa Mateo, thank you so much. That is the world famous newspaper segment. You know what? You love it here on the Bloomberg Surveillance Program.
This is the Bloomberg Surveillance Podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.